I'm Sam Hadden. I'm a real estate investment specialist based here at CY Property, bringing you a market update today with regards to the Perth property market and the economy, with a lot of valuable information and insights today, which is going to help you to navigate and understand this variable time that we're experiencing now, with a lot of changes that are coming into 2026. So I'm going to do my very best to make this a great use of your time over the next 15 or so minutes. I'm going to just share my screen now and I'm going to take you guys through a presentation. Now, with this, I'm going to try to move relatively quickly, but of course, feel free to stop the video at any time if you are particularly interested in some statistics on one particular slide. So, as an overview of the topics today, Perth real estate market statistics, economics and commentary, some case studies and opportunities that we see in the market, supply and demand, affordability and finance, and some forecasts from some reputable economic outlets. Now, as a broad market summary, what we see as a strength in the market is, of course, the broken record we've been hearing for a while now is low listings and low vacancy. New construction levels are still far below population growth and demand. We'll go through some stuff that will show you that that is still probably going to linger around for a few years. WA has a very strong economy, strong employment and infrastructure projects, and the government first home buyer grants are still helping a lot of first home buyers into the market. Now, the weaknesses are higher interest rates and inflation affecting cost of living, global economic risks, housing affordability at record lows, population growth starting to slow, and government threatening of tax reform for property investment. We'll go through all of this in a little bit more detail. Now, starting with house prices, so according to CoreLogic, in March, nationally house prices rose 0.6. Perth, of course, the highest, 2.5% for the month, 7.3% for the quarter. The price points below the first home buyer grant are still pushing the lower price points at a higher growth rate. Investor activity is very high, but it still remains the case that approximately 68% of the market is owner-occupiers. Now, looking at the top 5 capital cities around Australia, Sydney, of course, 1.6 million, slow growth of 5.6%. Brisbane at 1.2 is 17%. Perth ticked over the $1 million mark at 24%. We're now above Melbourne and Adelaide, sitting in the 900s. Now, the median house price and the growth figures, you may see them change depending on where you're getting the source from, whether it's CoreLogic or REWA or realestate.com. They just track slightly different data, so it can be a little bit annoying, but generally they all land around a similar level. You'll see the guide. Now, what's most interesting here is the growth in the right-hand column since COVID. Perth leading the last 5 or 6 years with 119% growth, which is quite staggering on the face of it. But as we know, prior to COVID, Perth had 6 or 7 years of stagnant or negative growth for a long time with a prolonged downturn. So you could say we were very undervalued. It shouldn't have been that bad, and we were playing catch up. But nonetheless, I think we have seen the lion's share of the growth, but we're still fundamentally very strong in Perth, and we're going to go through and analyze this as we go. So here, I'll breeze through this one, pause if you like, just some rolling statistics of quarterly growth across the last 5 years and 12 months and the past decade as an average growth. We've now gone back up to an average decade growth of 7.3%. In terms of the rental market, most cities are all below 2%. Some cities are below 1% vacancy rate. So renters still having a bit of a hard time, and vacancy rates have also started dropping again to 2023, 2024 levels. Now, Perth's median rent got to $740 a week, just below Sydney at $870. Now, what's interesting as well is that the yield is compressing. Now, the yield, of course, is the percentage of rental income you're getting versus the value of the asset. And a few years ago, you're probably looking at about 4.5 to 5% to buy a house in Perth. Now you're dropping down to 3.6, which is kind of in line with all of those other cities apart from Sydney, which is a very low yield. But when you do look at units, you're still getting a quite attractive yield, according to CoreLogic, 4.8%. But of course, as we know with units, generally what you're sacrificing is a little bit lower maintenance and a high rental yield, but at the compensation of a lower capital growth compared to houses, generally. However, in 2025, according to REWA, again, these median house prices are a little bit different, but what they showed with this report here is that units grew more than houses in 2025. Now that, I believe, of course, is due to the fact that units were probably a bit undervalued. They hadn't really had as much growth. Generally, people prefer houses, but now with affordability and house prices getting quite high and the first home buyer scheme coming in to help first home buyers come into the market, 5% deposit, that's driving unit prices quite a lot. And interestingly, down the bottom, the type of unit, number one was villas. Villas have grown the most in 2025. Some top performing investor areas in Perth. You've got house on the left, units on the right. It shows the total capital growth and the rental yield. So have a look at this if it interests you. Typically, they are the more affordable areas that are still within commutable distances to the city and still have some local amenities there. So you've got places like your Canningtons, your Middle Swans, your Girraweens, your Ascot, Belmont, Queen's Park, Osborne Park, all those types of areas. Now, some observations I've made in the market. I was helping a client to buy recently. We had a budget of around $1 million, just over $1 million, which is around the median house price for Perth. And what we found was that we wanted to try and be as close to the city as possible. But at that price point now, to get a house on a full block, you're really looking at areas that are 30, 40 minutes out of the city, which is getting a little bit far. And then we had a bit of a revelation where I found that townhouses in very good areas were presenting very good value. So this one here in Rivervale, it's only 5 kilometres from the CBD. Lots of local amenities, private schools, Catholic schools. It's a modern 2-story home. Now, with construction costs now, the cost to replace a 2-story home is astronomical. A lot of builders are not even accepting builds for 2 stories at the moment. Too hard, too costly, too slow. This was a great purchase, strong rental, and no strata fees at all. So maybe take a look at townhouses. You can still get some land value, a little bit less land, obviously, but you're getting a great dwelling that still has an al fresco and low maintenance. Or a unit in an area that's less than 15 Ks from the CBD, great for first home buyers or investors who want a slightly more affordable option with local amenities here. You've got a 3x1 villa in Cannington from $729,000. In terms of areas, 2 areas that I think are pockets which would present good value and do well. In the southwest corridor, if you think Hamilton Hill, Spearwood, Lake Coogee, Kwinana, those types of areas, all along that southwest corridor, you've got the AUKUS project, $8 billion investment, 30,000 plus jobs, lots of shipmaking, maritime defence projects. You can still buy homes around the $1 million mark or villas less than $1 million, 30 minutes from the CBD. And then you have the northeast inner, but on the east side of the freeway, you can get very good value. So think areas like Balcatta, Nullamara, Greenwood, Hammersley, things like that. They're close proximity to the CBD, but just because they're on the east side of the freeway rather than the west, you're getting much better value for money at a much better price point. Now, you can buy villas in these areas for $700,000 to $850,000. The replacement cost to buy the land and build these things would be around $1 million. So they're presenting very good value, and I think you will do well with a product like that. Now, what we're seeing here is, of course, in the last 4 or 5 years, listings have been extremely low. We would all love to see more houses on the market, and time it takes to sell a home, they're selling so quickly. But we have just started to see in the last month listings start to come up again and days on market. So let's follow this space. I think it's going to make it a little bit healthier for everyone, but I don't think it's going to get, astronomically worse compared to what, like, say, going back to 2018-19, where we had triple the amount of listings, but it's definitely trending that way. Now, WA, according to CommSec, is the number one economy in Australia for the last 5 quarters. Just things like population growth, unemployment, household finance, infrastructure projects, all really giving us a good position as a state, which at the end of the day, the property market sits on the economy that's behind it. So That's really, I think, what's going to underpin our market to be a little bit resilient, but that doesn't mean that we're not going to slow down. AUKUS project, as I said, $8 billion, 30,000 jobs with Australia, US, and the UK, all down on that southwest corridor. The airport in Australia, if you've travelled recently, you'll see a lot of construction there, $5 billion to make Perth the second biggest airport in Australia. We're becoming more popular with international immigration, business, tourists, and so on. So it's going to make Perth airport fantastic. Now, interest rates. So the RBA is in a tough spot. Inflation's rising again. We've had to reverse the interest rate drops that we had last year. Energy prices have bounced back after government rebates, construction costs, labour costs, now fuel and other supply chain issues. They're expecting another 3 rate rises from what we've already had. So that'll be a total of 5 this year. So you can see on the graph here, average mortgage, $600,000-700,000. That's going to add $4,000 to $7,000 to household budgets. Bit of a rough ride, and it's the blunt tool that the only thing that the RBA has to reduce inflation, unfortunately. And the Iran war, of course, supply risks. Australia was the 3rd worst hit with fuel prices. We've got issues with natural gas and fertiliser, unfortunate, and we all hope that this doesn't extrapolate much longer, but it's a big uncertainty. Now, interest rates plus house prices, if you like, study this graph. It basically shows that, broadly speaking, across Australia, when interest rates have gone up, the house prices have not necessarily gone into a decline, sometimes a decline, but certainly slowed down to either very minimal growth or negative growth. Tax reforms for property investment has been very loud on the news recently, and the best of my research from some economists and all the talking heads gives us a few proposed changes. Now, we won't know until, of course, the budget comes out and these are set in stone, but the main proposal is capital gains tax discount. If you hold the asset for more than 12 months, you currently get a 50% discount. They're talking about reducing that to 33 or 30%. They're possibly talking about ring fencing negative gearing, preventing investors from negative gearing too many properties. They may put a limit on the amount of money or the amount of properties in total, as well as maybe looking at some other income issues, such as people buying properties in trusts, businesses, and being able to divert the income. So there may be some tightening there. Now, just obviously, don't make any big rash decisions or panic. If you've got any professionals who can help you to assess your situation and the implications for you, happy to have a chat with you as well and guide you and refer you to an accountant or a financial planner if you need. But broadly speaking, it is going to potentially hurt us a little bit. We don't know if it's going to be grandfathered or not, but it would say rationale and fairness would prevail that it would be grandfathered. Otherwise, you would be moving the goalposts backwards and changing the rules in the past. First home buyer scheme, very controversial because it's helped a lot of first home buyers into the market with a 5% deposit. But in a market where we don't have enough properties, it's making it extremely competitive. I sold a property under the first home buyers cap and I had 15 offers from first home buyers. Very, very hard on both sides. But basically, houses under the first home buyer price limit are growing in price much faster than properties that are above the first home buyer cap. It's categoric with the statistics you can see. Housing supply. Now, population growth in Western Australia is forecast to be 2.8%, averaging 50,000 people per year as per the last 5 years, and that's looking like it's going to continue that way. And of course, the construction figures from the HIA show that we were 4,500 homes or dwellings short in 2025. That's not helping us, of course, with the new issues that we're having with construction costs going up. It's probably going to hurt us even more. But at the end of the day, in the short term, it doesn't look like there's any reprieve for this, where, we're just not getting enough apartments or high density out of the ground and able to build enough houses for the population. But affordability is becoming a big issue. The CoreLogic and the RBA have done some statistics based on people being able to afford a 20% deposit and mortgage payments being 28% of their income. And as you can see on the graph here, the median house price versus the capacity to pay, the gap has been getting wider and wider and wider, and the gap has never been this wide, as you can see on the graph here. And the affordability ratio, which is how many years of income to house prices, is 8.2, which is the highest on record. And then the rental affordability index is also at record lows. So it's putting strains on household budgets to be able to pay more for housing. And so another reason why we think that growth is due to slow down. High investor activity. So basically, there's statistics that show how much percentage of homes are purchased based on finance. The banks put out a report and show the percentage of loans that were taken by investors or owner-occupiers. Now, in one of the recent quarters, that hit 38% to investors. That's the second highest we've seen since the peak in 2015, where investors made up 45% of the market. And that's when APRA came in and brought in a lot of lending restrictions that they imposed on banks, that they couldn't lend as much money to developers or investors. And that really did impact the market. So that's something to be aware of that they are looking at as well, possible lending restrictions via APRA. Consumer sentiment at record lows, unfortunately. A lot of people really feeling the cost of living and a bit worried about some of the things that are happening globally. So really hoping that this turns around for everyone. Now, when it comes to our property market in Australia, we are very robust, and it's pertinent to look at some of our neighbours, though. You know, they are different countries and they are different markets, different economies. However, Canada and New Zealand have had some tax changes and immigration changes, which have resulted in their property markets actually declining in the last few years. So, you know, we're probably not immune to it. And it is something to just be aware of, that property markets can go through cycles and we may be at risk of some softening in prices. But forecasts show categorically, with places like SQM Research and ANZ, a lot of reputable economists out there are saying that Perth is still looking very strong. Now, these may have been done before some of the recent shocks in the global economy, but they're still forecasting sort of 10 to 13% growth for Perth, which we're definitely on track for at the moment. But what's interesting in the ANZ one is that you can see in 2027, next year, they're only forecasting 1.5% growth. So 12% this year, 1.5% next year. So I mean, it's not crashing, but, you know, it's definitely slowing down, right? But I think with supply and demand, it'd be very hard to see prices having a significant drawback, but certain areas and certain segments of the market will feel the pinch more than others. And generally areas that may have been hotter in the boom may have a bigger cooling off. So I'd be very wary of areas that have been really pumped in value. They may be the softest when the market cools down. But I love this picture because it just gives a broad market perspective. It's a graph made by Propertyology. It's from 1971 to 2023, so it is a couple of years old, but it paints the picture. It shows you the green line of house prices, and then it shows you recessions, global financial crisis, war, mining downturns, and so on. And you can see there are some dips in the market from time to time. But ultimately, if you're looking at taking a long-term view with property over a 5, 10, 15, 20-year period of time, you can generally see that you're having a pretty resilient growth over time. So, guys, I've been Sam Hadden. Just a quick introduction about me. If you'd like to have a chat with me, my background is I'm have 5 years experience in being a property strategy specialist. I have been investing since 2009, 16 years. I've got 7 properties, residential and commercial, accredited real estate agent. I've studied professional finance with the Monarch Institute, member of the Property Investment Council of Australia. I've helped hundreds of clients to buy over 120 properties. And as I hope that you can see from this little presentation, I'm a passionate market analyst. So I really hope that this has been valuable for you and insightful. Feel free to reach out or leave comments, and would love to help you, and have a great rest of your day.